Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Well, so I'll just let you have a quick look at the disclaimer. Just run through some of the key objectives of the webinar. We think markets generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be stories or narratives, which can be long-term fundamentals or short-term technical themes that increase or decrease in importance over time. Our goal is to break down all the market complexities and jargon that you do read about. So if you do have any questions, please do ask them along the way, and we'll try and answer those as best we can. Anything you look at, any setups, anything we're talking about, then please do ask away, and we will answer those and try and break down, as I say, all that jargon that you probably read about a lot. Okay, it's just after 11 o'clock in London, UK time. So firstly, yeah, just trying to digest really all the huge risk events, obviously, of the last week or so, really, and the repercussions for those, the effect on price action for the various asset classes, currencies, equities, commodities, not so much, but fixed income for sure, with treasuries moving ever higher as well, which has been supporting the dollar, which is then moving ever higher as well. And stocks have just paused, really. I'll just focus firstly, I think we'll just run through, the election repercussions on stocks. We'll have a couple of charts actually that we used last week that we quite like, that some of you might have missed, and that for sure just giving you a different perspective on obviously this exuberance that we're seeing in stock markets for sure. So we'll just go over those charts again as well. Before then, just looking at the general moves after the election. We did highlight that, of course, last Wednesday, but it was very early on post-election. And we'll look at the dollar as well, and the story around the dollar, of course, on what's happening now, as well as on euro dollar and some of the technicals. After the election sort of digest, if you like, summary, we'll look at the Fed meeting. Of course, that was last week, and the Bank of England meeting as well. And then if we have time, or definitely we'll have time for a preview then of the US CPI data, which is coming up very shortly, which would be the first test really of all of this price action that we're seeing post the election last Tuesday now, so over a week ago now. Firstly, stocks, I think it's important to just see where we are with stocks now. I've got a chart here that you can see of the S&P 500. Pretty simple what's been happening, obviously, with this run up in the Trump trade that we've been highlighting over the last few weeks, of course. Trump's policies, of course, seeing as being positive for stocks, positive for the dollar, inflationary, but also lower taxes and deregulation, which should help profit margins, especially for US companies. And it's really all about this US exceptionalism theme, and making America great again, regarding the economy, regarding corporations as well. Stocks, just for your guide, of course, they had their best week in a year last week, of course, buoyed by this frenzied rally. The S&P closed up for a gain of nearly 5% over the last previous 5 days. That was 4.7%, I think it was. That was its best performance since early November 2023. Friday, actually, we did push above 6,000 for the first time, and we peaked at 6,017 spot 31. Wednesday's 2.5% jump, actually, post-election, was the S&P's best day in more than 2 years, in fact. Interesting, I think Biden's bump in stocks after his victory, I think stocks, the S&P gained 2.2% then on the Wednesday following the election. But this time, well, the Dow jumped 1,500 points. That's its fourth biggest points gain ever, over 3.5%, record close, 43,729. And then, of course, as I mentioned, the S&P, the Fed cut rates, of course, as expected, really. And really now we're just seeing this sort of element of a relief rally, if you like, following the clear-cut election result. Let's not forget that it's an overwhelming victory for Trump, for the Republicans, and that is really what markets want to see. They want to see less uncertainty, of course. There's a lot of conjecture. Even we thought really that the results might not be known for days, even weeks. And we were citing, of course, previous elections going back to 2000, actually, when it took over a month or around a month, really, for Florida to be called, if you remember at all. And then, there was worry that this election would be very similar. Polls had, of course, pretty much Trump and Harris neck and neck. Of course, the betting markets were completely different, and they basically called it, if you think about it, with them being heavily skewed towards Trump. Poly market, especially in the weeks ahead, before the election, and then obviously that's come to pass. Essentially, we now know who the president's going to be. We kind of know what the policies are about generally, although we don't know the finer detail. As I say, deregulation, lower taxes, higher inflation, the three sort of key points about Trump's economic policies, at least. And we've just sort of taken a pause off that. You can see the S&P 500. If I just pull up the NASDAQ, similarly, just to slow up after this big sort of burst higher. It's actually, I think, as I said, the first down day since the election. And you can see the Dow there just falling off its high at actually 44,486 now. That's from Monday's record high. Interesting, I think, as well, we've got the Russell 2000 here. This is a small cap index, and you can just see that massive break higher on Wednesday after the election. Really interesting. Generally, sort of higher yields don't really help small caps. That's typically sort of seen, but the small caps index, the Russell 2000, that had, well, jumped by nearly 6%. That was its best day since November 2022. But really it's optimism over these lower taxes for businesses, for individuals, which is or sparked that rally, and then we got up to that that level that we have seen previously from 2021. So just below that, actually, really interesting. Virtually tapped it and then have just backed off it. So that's probably big resistance, really, you would think, in the small caps. If you do look at this, 2460 is that high. I'm just going to show you now a couple of those charts, actually, that I mentioned. First of all, this one I did show it you last week, but it is definitely worth showing you again. Just showing basically divided government means over time since 1928, actually. So decent sample set, shall we say. Divided government, less annual returns on the S&P 500 than a unified government. We've certainly got a unified government, most certainly probably now, I should say. I'm not sure the result is yet called, the final result anyway, of the Senate, but if it's Republican controlled, then you can see better returns seen in the S&P 500. Also, I like this chart, and we'll show it to you again. It's from the FT, and basically around all the sort of hubbub, the noise, the exuberance, of course, that we're seeing post-election, post-Trump. Historically, again, it's relatively, presidents relatively have a little impacts on financial market returns. So there are, of course, these short-term market reactions to an election, but longer-term equity, asset class, and sector returns not generally reflective of a presidency. So returns, in some cases, actually the opposite to those implied by, of course, the amplified electioneering we get, and also yes, that means the stock market kind of generally performs well regardless of who is in the White House. One exception, of course, negative annualized return was in the George W. Bush term. But since Carter's presidency, so that's going back many decades, S&P basically has had double-digit annualized total returns during every presidential term except that one. And that was when the tech bubble burst, essentially. Interesting as well to point out, and I think I may have done previously, but Obama and Trump's first presidencies, they returned near identical annualized returns, 16.3%, despite, of course, their starkly different goals and policies. So just something to note there. The other point as well, with sectors, actually always interesting, actually. Investors, of course, we anticipate that a candidate's proposed policies and regulatory framework will determine sector returns, essentially. But again, history suggests presidents do not have as much influence on sectors as is commonly thought. And in fact, actually, sector returns are sometimes the exact opposite of what was anticipated pre-election. So again, an example, if you think of Trump, 2016, 1.0, he kind of denigrated the tech sector in his campaign. He pushed to expand US energy production. But then technology turned out to be the best performing sector during his administration, and energy the worst. And even Biden, currently, he entered the White House emphasizing clean energy and other really ESG priorities, environmental, societal, and governance priorities. And yet energy, a sector dominated by the traditional producers, has so far been his terms top performing sector. Yeah, just a couple of points there in amongst obviously all this exuberance that we're seeing. I just then will pull up another graphic actually, which is this one. We had this one again last week, but again, it's worth pointing out. And if you want to just read some of it, just about the different asset classes, this is probably holds still over the longer term. It's certainly worked over the near term. And it's really this Republican hat trick, really, of the presidency, the House, and the Senate, Congress control, really, which is giving this sort of big version of the America First trade. As we've said, equities higher, yields higher, the dollar all jumping higher, and just expanding on those policies. Then it's really betting on a strong domestic-driven outperformance of the U.S. economy, as I've said. The US yield curve is really interesting at that kind of staged a bear steepening move, basically, with yields rising across the curve. So from the near to short term 2 years out to the long end, sort of 30 years. Again, a highly stimulative fiscal policy will not only support growth, but also inflation and potentially fiscal deficits. And interesting, actually, we saw that sort of 10-year yield pop higher, of course, but then just pare back to its pre-election levels, actually, essentially because the sort of fiscal deficits were easing. But then now, again, we've seen a move higher in yields this week. All in though, sort of that scenario does see then little reason for the Fed to take aggressive action to prevent basically any unwarranted slowdown in growth and or the labor market basically eased expectations for Fed easing towards the end of the year and of course out towards out across next year as well. And the rise in long-term yields basically suggests this sort of higher fiscal and inflation risk premium. For the dollar, similarly, greenbacks jumped higher across all majors, and really now we're seeing a sort of second round of post-election Trump trades. That's taken the dollar index to the 2024 highs. And markets really trying to get a grip of the sort of dual narrative now of wider rate and growth gap that we're seeing, differentials really between the US and other developed countries. Of course, we have that latest news that Elon Musk is joining the administration. He will lead a Department of Government Efficiency, aims to slash bureaucracy and spending. It's probably too early to tell what that kind of means for the public finances, but does confirm that Musk will play basically a key advisory role in the Trump administration. And then that fuels again those expectations for deregulation and looser taxation. Also comes on the back of reports last Friday. Actually, Trump is lining up Robert Lighthizer to run his trade policy. If you remember, he was the US trade representative from the first administration, and essentially he's an arch hawk on trade. So, for example, he apparently encouraged Trump to intervene and sell the dollar to support US manufacturers during that first administration. And then really one of the big questions now going forward will be the timing of the trade agenda. So I think most really have assumed that that will come later next year, sort of early 2026 potentially, for basically an introduction and then a ratcheting up of tariffs, basically because it takes time to conduct trade investigations. But now we are getting some reports suggesting tariffs could come earlier due to the results of existing trade findings. That is really key for the dollar. And then it's key, of course, for the Fed's kind of recalibration to less restrictive monetary policy. We do get as well end year dollar seasonal patterns, and ultimately then, as we've said, it's basically the clean election result, the relief rally, really boosting US consumer and business sentiment at the same time as weighing potentially on business sentiment elsewhere. Remember, one of the biggest negative impacts of tariffs is uncertainty weighing on business investment. The flip side, of course, then sees the dollar continue to strengthen, certainly into New Year or into year end. And we've seen that ongoing move already. If I just, I wasn't going to, I'll just show you the DXY chart actually. Just bear with me 1 second. So obviously the dollar index chart versus 6 of its major trading partners, euro being by far the biggest weighting in this index, which is here. Hopefully you can see that now. Yeah, just checking you can see the dollar chart actually, which I've got up here. I'm pretty sure you can. Yeah, so we're just up to these sort of levels above 106 now. You can see the big move in the last few days only, and obviously the break higher on Wednesday after the election. Yeah, not too much more to say really post-election now. I think giving you some things to think about, and also obviously some of these appointments which are pointing to exactly what Trump has said he kind of wants to do anyway. Yeah, you can just see these highs on the dollar index chart. Probably a key high from April now is 106.51. That's the year-to-date high. Before then, we get to highs from October last year at 107.34. Yeah, the easing back just before the election was really sort of positive for bulls, and then the break higher. But we are coming into resistance and potentially overbought territory now. Just probably will want to touch on euro dollar as well. Obviously the most popular traded major. Which you can see now, just double checking. Yeah, you can see that, so that's good. Apologies if you couldn't before. But for the euro dollar, yeah, big selling recently. Of course, you can see coming off this sort of 112 resistance from September. Of course, then we popped high up above 109 briefly, but then collapsed really. And now we're down to the year-to-date high, which is at 106.03, and we're just above that now, though we did break it over the last couple of hours and yesterday as well. Just pulling back, the next level we have is probably this major low from October last year, which is at 104.48. Euro dollar, yeah, being hit by widening interest rate differentials. Basically, that's between the US 2-year, which closely maps the Fed funds rate, of course, with Fed funds Fed rate cuts being reined in for next year, and then the Eurozone 2-year rates really blowing out. Oh, sorry, that spread is widening basically, which is driving then euro dollar selling as markets potentially price in more in the December ECB meeting. Essentially, yeah, there's more risk premium priced in now to the euro due to the protectionism, and potentially as well, of course, geopolitical risk. And markets really doubling down actually on their expectations that ECB will cut rates more than the Fed ahead of the tariff impact on growth. As I say, 104.48 is a key number, really key level in euro dollar. And I know that some sort of Wall Street City economists looking at sort of parity for euro dollar later on in 2025, when basically the full force of the protectionist sort of policies become clear. There's some time to go before that though, but just letting you know what some are thinking out there. Interesting actually, of course, if you just step back though, Trump has said he wants a weaker dollar. That's important, an important part really of his hopes to raise the US trade balance. But of course, at the moment, that is looking very tricky with this epic rally really that we're seeing in the dollar at the moment. Okay, I will move on from the election now and just pull up the graphic we use, but it's a review of the Fed meeting from Thursday. They unanimously cut rates by 25 basis points to the range now of 4.5 to 4.75%, widely expected. And with, well, the meeting giving little guidance for 2025, market reaction generally muted. You'd kind of expect that, obviously, post-election. The Fed is still at the moment, is still in a cutting cycle. The economy is on a solid footing, but inflation kind of continues to cool. We'll see what happens today, of course, but labor markets are no longer a source of inflation. If you remember, we've kind of moved on from price pressures towards growth, and that has been the issue over the last few months. Data has generally been somewhat stronger than expected, and the downside risks have eased. However, how that translates to the rates outlook and the Fed, of course, remains uncertain. All options, though, sort of do remain on the table going forward, including faster cuts if the labor markets weaken unexpectedly, but also slowing down the pace of easing if the Fed estimates that it's approaching neutral faster than it thought. The Fed, Powell did mention paying close attention to inflation expectations, actually. And Powell also said he had taken note of the recent uptick in market-based expectations following the election results. Powell also said about the election, he made it clear that the result will not have any near-term policy impact, even if in the longer run fiscal policies can, of course, affect the economy. For the time being, as long as we know very little about those changes, there is, as he said, I think simply nothing to model. And he avoided discussing how this could impact rates outlook for the December meeting and beyond. Just remember, in their September dot plot, the median dot plot was for 50 basis points of cuts. We've seen 25 already, so obviously pre-election that was, but they expected, the median dot plot expected another 25 at the meeting in December. Interesting, I guess, on a personal note for Powell, when asked if he would resign if requested to do so by Trump, he very firmly said no. So yes, essentially, they are giving very little guidance, but obviously markets expecting them to rein in the rate cut butts, and that's what we've seen really. I think there's only around 75 basis points priced in now for the whole of next year, and now that sort of much higher chance of a pause in December now, nearly 40% against a 60% chance of another 25 basis point cut. As I say, that has moved quite dramatically since the election. Okay, that's the Fed. We also had the BOE, the Bank of England. They cut rates as expected as well by 25 basis points, taking the base rate down to 4.75%. Importantly, probably the committee, they basically shifted to a more hawkish stance in terms of their gradual approach. Last meeting, the gradual approach, that was warranted for most members, and now it's included in the bullets in the statement regarding basically the entire MPC, not just most members. But it was generally a muted reaction again, market reaction that is, MPC likely aiming for that following, of course, some jitters after the UK budget the previous week. They really sent a signal of, as I say, a gradual cutting cycle, marginal hawkish bias given the inflationary budget, but not spooky markets following those market reactions that we saw. Expectations then for the Bank of England to remain on hold at its December meeting, then maintain its gradual approach. We don't get fresh forecasts until February. I think they're quarterly fresh growth and inflation forecasts. Interestingly, again, some economists expect cuts actually at every meeting starting in February next year. And that's a step down from a quarterly pace, but it is mixed up actually, and some other economists only thinking that we get a quarterly pace of cuts. Markets actually now see only around 50 basis points in total of cuts for next year. So certainly there's some room for dovish repricing there if you think inflation calms down and potentially we get a rollover in some of these economic data releases out of the UK. If we just get cable up actually. We can just see was holding up fairly well around sort of 130, just below there you can see, but we did have lows of 128.33. That was on the election day, post-election day, sorry, the trading day afterwards. But then we could the halfway point that you can see of this sort of April to September move, that halfway point's at 128.62. That was acting as support, and then we've just basically broken down very sharply yesterday. We did have jobs data out, and the unemployment rate did tick up to 4.3% from 4%. Wages fairly steady, but we would caveat the jobless numbers. Certainly, the unemployment rate is prone to reliability issues still, and most policymakers do look through that, as do most market watchers that we speak about, so and read about and speak to actually. So really, as gilt yields are rising, there is a worry about the government's budget and their forecasts, and potentially that is hitting sterling. And certainly it took it down to this next level, key level 127.29. that's the 61.8 of that move from the April to September highs. 127.29 now. We probably should put the next, well, it's a minor fib level, isn't it? 78.6, but that is way down, closer to 125, and we do have these sort of levels in here around 126.17, and then possibly that level in early August at 126.64. So yeah, interesting moves for sterling, but a lot of people probably saying it's about time it moved lower, because potentially the Bank of England, although not yet, as I say, could turn slightly more dovish. But at the moment, they are, relatively hawkish, although that's not helping sterling due to the gilt moves. And that's gilt yield moves. This week we do get UK GDP, just to touch upon that. And we know already from the monthly data, the third quarter growth was significantly slower than we saw through the first half of the year. That probably doesn't say so much about a genuine slowdown, really, just more about the volatility in the data earlier in 2024. Survey suggests momentum has eased a bit, though the budget is seen to boost growth next year. We do get to hear from Bank of England Governor Bailey, actually, who makes an important Mansion House speech tomorrow evening. So just watch out for that. Will be interesting, and certainly interesting given the UK economy is performing okay, pretty well, relatively speaking. But obviously Trump's policies could prove inflationary, so Bailey probably may not want to repeat his narrative that UK rates could be cut faster than expected, which we sort of heard from him about a month ago. So a lot of different things happening there in the UK, but certainly that move lower is fairly bearish for sterling, technically speaking, at least. Okay, we'll get on to CPI data now. Just quickly, I've just got a chart here just showing you where we are with the different measures, CPI as well as the PCE numbers as well. Obviously the PCE, the Fed's favored inflation gauge, wider measure of inflation essentially, CPI being the consumer price index. And you can just see now we are expected consensus actually to edge higher, 1/10 higher, the headline to 2.5% in October. Month on month is expected actually unchanged at 0.2%. And then the core number, much more important really, strips out volatile sort of food and energy. That's forecast to have ticked up, actually, rising from 3.3 to 3.4% year on year in October. And especially the important month-on-month number is expected to stay actually at 0.3%, so unchanged from September. Just remember again, economists reckon we need readings of 0.17% over several months to bring inflation back to the 2% Fed target. And if we get 0.3, or if you look at the rounding actually, which is obviously what we've been prone to do recently, a 0.28 monthly gain would actually push the 3-month annualized rate of core CPI up to 3.6%. And that would also keep the 12-month annualized rate at 3.3%. So still above the Fed's target. Food prices expected to slow after leaping in September, but we could get, well, the risks are to energy costs possibly with upside, obviously around the Middle East tensions. Interesting, at that November meeting, Powell said that inflation has eased significantly, although core inflation remains somewhat elevated. And most of the recent inflation report was, I think he said, not terrible, but it was higher than expected. And notably, actually, he said 80% of the inflation basket is back to levels consistent with the Fed's objectives, but housing is the outlier. So just check that out if you are like to dig a bit deeper into the report. Housing, the key number, core, the key number, of course, and the monthly number as well. Yes, that's inflation, that's CPI. Thursday we get tomorrow producer prices actually, and then Friday we get retail sales. That will be interesting, certainly the retail sales report, because of how important it is for consumers, and has actually moved markets previously in the last few months. Headline actually still forecast to rise 0.3%, so just a touchdown from the 0.4 previously. But certainly consumer spending seems to be relatively robust, and again, that clear-cut election result could help prolong that. Okay, just checking, we've gone through the dollar index, we've gone through cable, looked at euro dollar. Don't see any questions. Always keen to answer any questions. I will just touch on another piece of data, actually. Australian jobs data out on Thursday. That is obviously after the RBA meeting, actually, which was just before the US election. Seems like a long time ago now. But the RBA, still an hawkish outlier among central banks. They kept their policy rate unchanged, basically, saying inflation remains too high, isn't expected to sustainably return to the midpoint of the 2 to 3% target range until actually 2026. So really that reinforces their hawkish nature. They're wary of the sort of persistence, I think, of core price pressures, and the ongoing strength in the labor market. Outlook still remains uncertain, really, though. Weak output growth is expected to recover, but money markets actually don't put a rate cut now. A first rate cut actually not priced fully until the middle of next year for Australia. And that's probably moved actually further out now over the last couple of days even. Actually, if we pull up the Aussie dollar chart, just to round up with that, just bear with me 1 second. Yeah, here's the Aussie dollar chart. Just want to check you can see that. Yes, you can. Yeah, and we do have the jobs data actually out of Australia Thursday, so overnight tonight UK time anyway. It's still expected to be relatively decent. Obviously, a pullback from the 64k in September, around 25k, I think is expected. Unemployment rate seen ticking up a tenth probably to 4.2 from 4.1. Economists say basically the final quarter of the year is usually softer for working age population growth, and then that means we're probably unlikely to see employment continue to rise at the scale we've seen in the recent last few months. That average actually has been 50k, adding 50k of jobs per month since June. But a 20k forecast basically for October, that roughly keeps the employment to population ratio steady. And yeah, probably consolidation in the unemployment rate. Yes, Aussie has been affected, of course, because of potential tariffs put on China, and then obviously that affecting the Australian economy somewhat. So yeah, interesting level here. We've got that spike low from last Wednesday at 65.11. We're just above that now, but we have tapped it yesterday and today. Lose this, then I guess we've got, yes, this fib level of this move at 64.75. Before then, that sort of spike low at the start of August at 63.47. I'm just pulling back. You can just see that's yeah, very strong level, as well as that medium-term level of 64.75. If we do lose, yeah, that last Wednesday spike low at 65.11. Okay, I'm going to wrap it up there. I don't see any questions, so yeah, really do appreciate you being on the call. Great having you stay for this length of time, and I hope everything's been clear. I think we have the next webinar in a few weeks' time, so hope to speak to you then, and take care out there.